You've spent your entire career building your retirement savings. You've been disciplined, patient, and focused. And now you're finally at the point where the question shifts from, do I have enough, to how do I use what I've saved? But here's what catches many retirees by surprise. Spending in retirement is harder than it looks. It's not just about budgeting every dollar. It's about coordinating income sources, managing taxes, and adjusting your withdrawals year by year in a way that protects your portfolio and keeps your plan sustainable. And here's the trap. Even if you have more than enough saved, poor withdrawal timing, inefficient income planning, and disorganized spending can quietly erode your wealth over time. It doesn't all happen at once. It happens slowly and often goes unnoticed until it's too late. And in this video, I'll show you exactly how the retirement spending trap works and why it affects even high net worth retirees, and what you can do now to avoid it. Hi, I am Michael Fry. I'm the founder of RWC for Life and president of Steward Financial Services. If you are approaching retirement or already in it, this video is especially important to you because while most people focus on how much they saved, the real key to long-term financial confidence is knowing how to spend it wisely. Stick with me and I'll walk you through the most common mistakes I see and the strategies that can help you protect your retirement income for life. So let's get right into it. Part 1, what is the spending trap? Let's start with what the trap actually is. The retirement spending trap isn't about reckless spending or lavish vacations. It's more subtle than that. It happens when income and spending become disconnected from strategy. In your working years, money comes in through your paycheck and you spend accordingly. But in retirement, you're now responsible for generating the paycheck from savings, Social Security, pensions, IRAs, Roth accounts, and investments. And if that income isn't structured properly, retirees often withdraw too much from the wrong account, trigger unnecessary taxes, undermine long-term growth by selling assets at the wrong time, and they create uneven drawdowns that become irreversible. The trap doesn't show up in year 1. It shows up 5, 10, 15 years into retirement, when tax liabilities are even higher, portfolios are unbalanced, and flexibility is gone. What starts as spending a little more while we're healthy turns into long-term erosion of security. And the worst part, most retirees don't realize it's happening until options are limited. Part 2, how the trap starts with disorganized withdrawals. This trap often begins with one simple phrase: we'll just pull from whatever makes the most sense at the time. But in retirement, what feels easy and what's tax efficient rarely is the same thing. Without a coordinated plan, retirees tend to withdraw heavily from traditional IRAs early because they're large and liquid. They delay using Roth IRAs, assuming they'll have time to save later. They ignore taxable brokerage accounts that could offer lower capital gains tax treatment. Overlook how today's withdrawals impact future tax brackets, Social Security taxation, Medicare premiums, and possibly estate tax. The issue is timing. If you pull too much from tax-deferred accounts in your 60s, you risk pushing yourself into higher tax brackets once Social Security kicks in, and again when required minimum distributions begin at age 73. But if you delay drawing from those accounts entirely, they keep growing and often can create a tax burden, which is a tax time bomb later in life. That's how a disorganized approach leads to a future you didn't plan for, with higher taxes, possibly a higher Medicare premium surcharge, less flexibility, and more of your estate going to the IRS instead of your family. And it all starts because withdrawals weren't mapped out intentionally. Part 3, the lifestyle problem, spending that doesn't adjust. Now let's talk about lifestyle. There's nothing wrong with enjoying retirement. In fact, you should. The issue arises when spending stays constant regardless of what's happening with your portfolio, inflation, and tax strategy. Let's say you've been spending $10,000 a month for the first 5 years of retirement, but during that time the market dips 15% or inflation rises. Your tax bracket quietly creeps up. If you continue spending the same way without adjusting where or how your income is sourced, you begin to draw down assets too quickly, sell investments at a loss, create higher taxable income than needed, and lose the ability to recover when the market rebounds. See, wealthy retirees don't necessarily spend less, they spend smarter. They understand that withdrawing $100,000 from a Roth IRA has a very different impact than pulling it from a traditional IRA or taxable account. They also adjust based on market conditions, reducing equity withdrawals in down years and relying more on fixed income, cash, or tax-free accounts when appropriate. That kind of dynamic income management is what prevents long-term damage. The trap isn't overspending, it's spending without alignment and watching your long-term plan slowly unravel. Part 4, sequence risk, spending and market volatility. This is one of the most dangerous and least understood risk in retirement. Sequence of returns risk isn't about your average return. It's about the order in which those returns happen and how they interact with your withdrawals. Let's take two retirees, both starting with $1 million, both averaging 5% annual over 20 years, but one sees losses early in retirement and the other sees gains early. The retiree who sees losses early while withdrawing for income may run out of money years earlier than the other. That's because withdrawing during a downturn locks in losses and reduces your base before it has a chance to recover. This is especially dangerous in the early years of retirement, when spending tends to be higher, portfolios are fully invested, and emotions are running high without safeguards like a cash reserve, bucket strategy, or income floor. Even high net worth retirees can end up selling low just to pay the bills. The wealthiest retirees avoid this by building non-market income buffers, so they're never forced to sell in a downturn. Because in retirement, volatility isn't just uncomfortable, it can be destructive if paired with poor timing and unmanaged withdrawals. Part 5, how to avoid the retirement spending trap. The good news, the trap is completely avoidable, and it starts with a few key shifts in how you manage your retirement income. Number 1, build a year-by-year withdrawal plan. Map out how much you need annually after tax, which accounts you'll draw from, and in what order, when Social Security should begin, how to minimize taxable income while maximizing flexibility. Write it down, review it annually. Don't leave it to memory or guesswork in April. Second, use a bucket strategy for structure. Divide your portfolio into 3 buckets. Bucket 1, 1 to 2 years of income in cash, high yield savings, or short-term bonds. Bucket 2, with 3 to 10 years worth of income in a balanced income producing investment. And bucket 3, which is for 10 years and beyond, is growth-oriented equities or alternatives. This gives you clarity on where income comes from and control to avoid selling long-term assets during the wrong time. Number 3, integrate tax strategy into spending. Every dollar you withdraw should be aligned with how it's taxed, how it impacts your overall income, and whether it affects Medicare premiums or pushes you into a higher bracket. How it fits into your estate and legacy goals. Coordinating your IRAs, Roth IRAs, taxable accounts, and annuities can often create more long-term value than chasing returns. And number 4, stress test your plan regularly. Ask your advisor, what happens if the market drops 20% next year? What if we live, or I live, to be age 95? What happens to the surviving spouse's taxes if one of us passes early? Are we withdrawing from the right accounts at the right time? Scenario planning today prevents regret tomorrow. Here's the bottom line. Retirement isn't just about how much you save. It's about how you use it without draining too fast, triggering unnecessary taxes, or losing flexibility when life changes. The retirement spending trap doesn't appear overnight. It creeps in slowly through small missteps, unchecked withdrawals, and decisions made without a clear strategy. But the good news is it is preventable. With a clear withdrawal plan, a structured income strategy, and coordination between your investments, tax, and estate plan, you can retire with confidence, clarity, and control that you've earned. And this is where working with a financial professional can make all the difference. If you're approaching retirement and you want to make sure your plan is working for you, not against you, let's talk. Click in the link in the description to book a free consultation. I'll walk you through your options and help you build a retirement income plan designed to avoid the trap. and protect your lifestyle for decades to come. Thank you for watching.